Hey everyone, Jeff Dorman, Chief Investment Officer at ARCA, back for another depressing week of That's Our Two Satoshis Live. For those new, don't forget we write a blog every week talking about the digital asset market. Try to keep it pretty even right down the middle. Hard to do when prices are crashing every week as they are in the equity market as well. But check out our blog, ar.ca/blog. You can find the one we wrote this week called the different types of depegging. And I'm joined today by a guest you guys are probably familiar with, Nick Coates. How you doing today, Nick?
Hey, Jeff. Doing good.
Good. Where are you calling in from today?
I'm actually in Seattle right now, visiting my twin brother and my girlfriend.
Does it feel different? Anybody look like they're cutting their spending habits yet or depressed from market mayhem?
Well, there was a line for gas at the Costco gas station that was about a 10-minute line, which they know is the cheapest place in the town.
Sounds about right.
Yeah.
It's interesting. We're going to get into the macro in a minute and the inflation expectations and consumer spending and all that. But before we get into that, let's get into what happened with Celsius and staked ETH and everything else regarding the depegging. So, look, Celsius is, it's funny. I always compare, I think Celsius is to BlockFi as Tether is to USDC. Meaning Celsius and BlockFi do the exact same thing. They're the same business. It's just that for whatever reason, people hate Celsius. And Tether and USDC are the exact same thing as well. But we know why everyone hates Tether because, 3 or 4 years ago, they admitted to not being fully backed. But if you actually looked at both of those companies objectively today, they're the same thing, right? BlockFi and Celsius are both lenders. You deposit your assets with them. They try to lend it out to someone else. But the dirty secret of all these guys is that there's never nearly as many people looking to borrow assets as there are people looking to deposit, which means they're constantly running a liability asset mismatch, which means they need to make up the yield another way, right? A very simple net interest margin business for a bank is if Nick lends me one Bitcoin and I agree to pay him 2%, and then I go find someone to borrow that Bitcoin and they pay 3%, that's an easy business, right? I have one Bitcoin on my liability, one Bitcoin and my asset, and I'm making a 1% spread. But because that never happens, you have to figure out a way to make up that yield. So in good times, there's a lot of different ways to make yield. In bad times, you start to do a lot more risky things. And the reality is both BlockFi, Celsius, Nexo, Cred Capital before they became insolvent and went bankrupt, it's all the same thing, right? They're basically running unregistered hedge fund strategies where they're doing all the same things that a hedge fund does. The difference is a hedge fund only has accredited and institutional investors investing in them, and those investors do 12 to 24 months of due diligence before investing. Whereas you can sign up for BlockFi or Celsius or Nexo in 5 minutes on your phone and deposit assets right away without having any idea what they're doing with your assets. So long story short, these have always been risky businesses. Nothing has changed ever in the history of these businesses. What has changed is that because Celsius in particular does a lot of these things on chain, a lot of DeFi detectives and blockchain detectives are starting to figure out what exactly they're doing with those assets and are starting to target them. And one of those things, and Nick, you can talk about this better than I can. One of those investments that Celsius has been making was taking their ETH, converting it into staked ETH via Lido, and then taking that staked ETH and depositing it on Aave and other places where they can use it as collateral to take out a loan and take other assets and do whatever they want to do with it, either more DeFi farming or buying other assets, et cetera. And staked ETH is deposited. Well, actually, why don't we start there? Is that a fair representation of what Lido is in staked ETH, or did I miss anything there?
No, I think you pretty much got it.
Okay, so one staked ETH is always worth one ETH. The problem is, just like a lot of the things we've seen, from Grayscale's GBTC to Nexus Mutual and the assets that back the capital pool, to even Tether and USDC with the assets to back that, is that there's not always a mechanism for redemption, right? There is a mechanism of redemption for an ETF. If an ETF peg breaks, you can always redeem or create new shares to make that ARB close, right? Tether and USDC. If the peg ever breaks, you can always actually redeem one asset for another to make that ARB close. But in the case of staked ETH versus ETH, once you get that staked ETH token, you're not allowed to convert it back into ETH until after the merge. And Nick, what's the timing right now on the merge, or what's the expectations for the ETH 2.0 merge?
somewhere around Q3, so September timeframe, I think is probably a good bet. But then there's going to be, the word has been around 6 months delay after that before you can actually withdraw the stETH. So there's a liquidity mismatch there.
Exactly right. So by the way, anyone who wants to read it, we go into much more detail in the blog itself. But the reality is, anytime you have an asset that is explicitly backed by another asset, in theory, they should be worth the same. But there's a reason that they trade at a discount, and that discount could be because of liquidity. It can be because of potential risks, like in this case of staked ETH. There's slashing risk, or there's risk that the ETH 2.0 merge fails. There's all these different reasons why staked ETH should trade at a discount to ETH, and the same reason that GBTC trades at a 30% discount to Bitcoin. Even though every one GBTC is equal to one Bitcoin, because there's no mechanism to force that ARB to close, it trades at a significant discount, because that's the market's way of telling you that that's the yield they need to basically own a zero coupon bond. So let's take GBTC, for example. If I buy GBTC right now at a 30% discount to fair value, and I think it's going to take 2 years before Grayscale can convert into an ETF where that ARB will close, I'm basically buying a zero coupon 2-year bond that yields 15% per year, right? That's the math. Same thing with staked ETH. If staked ETH trades at 95 cents on the dollar, and you think that it's going to be a year before you can get converted into your ETH with 100% probability, you're effectively buying a 1-year zero coupon bond with like a 5% return. So that's what's happening here. The problem, so by itself, any asset that is fully backed by another asset is a pretty good asset, right? You generally want to buy that when it trades at a discount. The problem isn't Lido or staked ETH. The problem is everyone knows that Celsius owns a ton of that staked ETH, and everyone also knows that they've taken that staked ETH and they've put it on Aave and other places to take out a loan. So if you want to put Celsius out of business right now, you can target that staked ETH peg, and you can try to push it lower and get to a point where the collateral they have on Aave is no longer worth enough, and then they have margin calls. And you're seeing the same thing across everything that Celsius has done, from their staked ETH position to any assets that they have on MakerDAO. Basically, there's a run on the bank at Celsius. It's a different run on the bank than what we saw at LUNA and UST a few weeks ago, because that was, get out because there is no backing and there's nothing behind these assets. Here, there is plenty of assets behind what Celsius is doing, but what they don't have is liquidity, right? So they probably do have the assets, and I don't know for sure. I'm not trying to speculate here, but there's a very high chance that Celsius has all of the assets to back the liabilities that they have from their depositors. The problem is they don't have liquid assets. So when everybody pulls their money out of Celsius all at once, Celsius has to sell what they can to raise enough assets to give back to the depositors. And at some point, they just run out of liquid assets, and that's probably what you saw yesterday or this morning when they finally announced that they're halting withdrawal. So if you have money on Celsius, it doesn't mean that you're going to lose your assets per se. It just means you can't access them right now because they had to put gates up. They had to basically say, we can't let anyone else withdraw because we don't have the assets. This can get messy, but this is also what bankruptcy court is for, right? In traditional bankruptcies, this is what happened. If you're insolvent and you can't meet your requests or your cash flows or your depositors, you would file for bankruptcy and let a bankruptcy court hold all of your assets and basically, over the course of 18 months to 2 years, figure out exactly who and when gets their money back, right? It's very similar to what we're seeing in Mt. Gox, and that's taken 8 years now for people to get those assets back. The assets are there, but you just can't access them yet. So it's certainly not a good situation. But from a market standpoint, the market sold off very heavily over the weekend, largely for 2 reasons, right? One is because Celsius themselves has been selling assets left and right to try to raise cash in order to pay back depositors who are leaving. And 2, because everybody is front running what Celsius is doing and selling what they can ahead of that. And I guess 3 would be because as these collateral levels continue to drop, it has that cascading effect that we all love and know so much about in digital assets, which is if you have your assets being staked somewhere, being lent somewhere, being used as collateral somewhere, when that asset value goes down, you have to top up those assets with other assets in order to make sure you don't get liquidated. So very kind of big spiral, similar to what we've seen before. But, I think the reiteration here is, even though this may have started because staked ETH is now trading at 95 cents on the dollar relative to ETH, there's no real inherent danger caused by the market route of staked ETH. This is not UST. This is not an unpegged stable coin. This is simply, the market is telling you it needs to trade at a discount relative to fair value right now. Anything to add, Nick?
It's essentially it's a bank run, right? I mean, it's kind of like Celsius is declaring a bank holiday and saying, you're not going to be able to access assets for this amount of time. But again, just in the same case as it is with a bank, that doesn't necessarily mean they don't have the assets.
Exactly, right. And look, usually, this used to happen, before you had FDIC protection, before you had the savings and loan crisis in the 1980s. This used to happen to regional banks all the time, right? A regional bank never actually has all the assets they say they do. All of a sudden, every customer shows up wanting their money back that's not there, and they have to close the doors and halt withdrawals and file for bankruptcy. It's a very similar process, only, in the traditional world, we have these ways to thwart that through FDIC protection, through other rules and regulations in the banking world. Obviously, digital assets has been, under the radar in terms of, these rules and regulations for a long time, and this is the result. So it's an interesting, case study in the sense that, this too will pass, right? Celsius is not going to be a forced seller forever. In fact, they're probably already no longer a forced seller since they've stopped the withdrawals. But, what world do you want to live in, right? Do you want to live in a world where literally every time something breaks, immediately you have a too big to fail kind of dichotomy where, some big government or some big player comes in and rescues everyone and just creates another bubble for the next 5 years? Or do you want to live in a world where things break and it causes pain and they work themselves out on their own? Obviously that has its drawbacks as well, right? People are getting really hurt here who have assets on Celsius and need them and can't get them. People who own a lot of stETH and are down a lot on their mark to market. So, I don't know what the right answer is, right? It's probably somewhere in the middle between this, fabricated, fake, traditional finance world that we've been in for the last 15 years post, 2008. And somewhere in between that and what we're living here, which is, things like LUNA and UST can go, to zero overnight, and things like, Celsius can implode overnight. So, this is neither, I'm neither supporting nor, kicking Celsius while they're down. I'm simply saying, this is the world we live in digital assets, when you have loosely regulated entities handling customer deposits and people's money.
Yeah. I think Ryan Selkis had the right take that, if we want to live in this world where we're not subject to that heavy hand of regulation, the firms in the industry have to go and actually do a better job of disclosing things themselves and being transparent about their own assets and their own liquidity positions.
Yeah, I 100% agree. I mean, I actually wrote an article in March of 2021, so almost a year and a half ago, talking about shadow banking. In fact, if people go on our blog at ar.ca/blog and search for shadow banking, you'll see that I wrote a very similar article to what Ryan Selkis and Masari said today, which is like, look, if you want to be an exchange in this business, or you want to be a lender in this business, like, you have the onus of providing transparency, right? You cannot do what these guys have been doing. You can't be an exchange that just lists tokens without explaining the inflation schedules or the unlock schedules. You can't be a lender, taking anybody's assets without telling them what you're going to do with those assets. So, there's definitely an element of self-reporting that certainly needs to be done in this space while we wait for the inevitable regulation that comes.
Mm-hmm.
All right, moving on though. It's not just digital assets that are getting smoked. The entire world is falling apart. Nick, what happened on Friday? What changed as a result of that CPI report, and where do we stand today?
Yeah, so we had really, for about a month or so, you had kind of most of the market, even digital assets included, kind of treading sideways. And there was some indications in the market, in pricing and in some data, that you might be seeing the peak of inflation. And really the last week or so has completely demolished that narrative and that kind of price action. We saw the CPI report that was the highest, another high, highest since 1981 or whatever it is. And then what really scared the market even more was the University of Michigan consumer sentiment report. So the consumer sentiment number itself was the lowest of all time, back to like the 1950s or something. And then
the lowest print ever, and that index has been around since 1952.
Yeah, 1952. And then there was a 30 basis point tick up in long-term inflation expectations. So this is consumers, what you're asking consumers what their expectations of inflation are going to be over the long term. And generally that number really hasn't meant that much, just because, you're asking people about something that's very ethereal. But in the last couple months and weeks, you've really seen that kind of spike up. And now we're at, I think, 3.3% for long-term expectations. And what that is saying is that people are actually starting to see the inflation baked in and starting to, think about that in their heads. So they're going to be asking for, higher wage increases. They're going to be expecting more. They're going to be spending faster when they go to the grocery store or whatever, thinking about the inflation. And that's what's really scaring the Fed, because they don't want that reflexivity baked into the inflation number. They don't want people to, once you start that spiral, it gets harder and harder to step on that and to put that flame out.
So I quoted you in the article that I wrote yesterday. What you and I were talking about over Slack earlier in the week. Here's the question that I think everybody has, is that if you go back 2, 3, 4 years ago, everybody said, I want to own digital assets, and specifically Bitcoin, but even other digital assets as well, because it's an inflation hedge. Paul Tudor Jones came out in May 2020 and said, I think inflation is going to go higher, and here's what I'm going to do. I'm going to buy 2s, 10s, or 2s, 30s steepeners in the Treasury curve. I'm going to go buy gold. I'm going to buy Bitcoin. I'm going to buy the NASDAQ 100. And here we are. All the inflation in the world is finally here, and every single one of these trades that was supposed to protect from inflation is failing miserably. Why? What's changed? How do all these things that are supposed to protect us against inflation not working at the same time?
Yeah, I mean, the honest answer is that most of those things that people were relying on as inflation hedges were actually not inflation hedges. They're real rate hedges. And what that means is that they're essentially expecting inflation to increase without the Fed tightening to increase the nominal interest rate. So like gold, for example, is the classic asset that has no cash flows and essentially just trades in line with real interest rates on a negative. So when real interest rates fall, gold goes up and vice versa. And so you've seen inflation.
So you're saying if the 10-year yield is constant, but inflation rises, real yields fall, and that was the trade that everyone was putting on.
Exactly. Yeah. So the nominal yield is just the real yield plus the inflation expectations, right? So inflation expectations is proxy for market-based inflation. The real yield is kind of like at least in the short term, it's a monetary policy indication, right? So when the Fed tightens policy, short-term real rates increase. And that is really what's hurting a lot of these trades that we saw, which is essentially that discount rates are rising over the long term. And so anything with cash flows far out into the future, or things that have no cash flows at all, those are going to be taken down because you're essentially saying the price of money is increasing.
So you're basically saying that there is a world where potentially these trades still work, right? You're long gold, you're long steepeners, you're long NASDAQ stocks, you're long Bitcoin and other digital assets. But that world has to happen in an inflationary environment where you still have growth, not where you have or where you have growth slowing, basically less fast than inflation is rising. Am I saying that correctly?
That could be it. The other place is just where you have inflation rising, but the Fed's not doing anything about it. And so you did see some of those things kind of work a little bit before, like just December, January timeframe, when the Fed really actually started to wake up to the fact that inflation was here and wasn't going away. But that very quickly fell apart as soon as people realized how hawkish the Fed was getting.
So when do these work again then? When or if you ever see it? Because like we all know that essentially in inflationary environments, you do need to own hard assets, right? You do need to own land, you do need to own commodities, you do need to own things like gold and Bitcoin. That is historically what does well. Stocks as well. Like you need to own this stuff to protect your purchasing power in an inflationary environment. When do these things start working again, where you actually want to own the assets that are inflation protected rather than flee them because the cash flows are all going lower and the valuations are lower?
Yeah, I mean, well, I would say something like gold has pretty much held in. I mean, it's down slightly, but considering everything else, how badly everything else is down, it's done a reasonably decent job of storing your wealth, not too much worse than just cash itself. But really, what the big thing right now is tightening monetary policy, right? As long as the Fed's getting more and more hawkish and real rates are increasing, real rates probably are at 25 basis points right now. If you think about, there's this concept called the what do you call it? Never mind. But the idea is that there's the way that the Fed sets interest rates is based on the long-term real interest rate. It's called the R star. It's basically an estimate of like what productivity and demographic growth in the economy is. Most economists put that somewhere around 0. And what we see right now is real interest rates are above that, which is really, it means that monetary policy is really tight. And that's what's really hammering assets, especially right now, is that we've got actually tight monetary policy. Whereas before it was kind of just like you had negative real interest rates, but they would get a little bit less negative or a little bit more negative. And that really wasn't as scary as this is actually tight monetary policy, something we haven't seen in a while.
So I have a theory, which I know you somewhat disagree with. My theory is, okay, once we get to the point where rates are just rising and we have higher rates, right? We have higher nominal rates. Potentially we have, I don't know if we're going to have higher or lower real rates, but we definitely are going to have higher nominal rates, right? I think that's inevitable, and the treasury market is telling you that. When you have higher nominal rates, most assets have valuations that go lower, really for a couple of reasons, right? One is that the DCF models that you mentioned, like, if you're looking at a long tail asset like a tech stock where most of their cash flows come at the end, right? You have a higher terminal value, and you have or a lower terminal value rather, because of the higher interest rates in the back end of a DCF model, right? So you have a lower valuation because of higher rates.
Yep.
Similarly, if you're a company, right, you have some form of cost of goods, right? You've got rent, you've got input costs, right? Something that is actively, lowering your earnings potential, even if your revenues are higher, because of the inflated cost of your goods. And then you have higher cost of capital, right? Obviously, if you have to refinance debt at a higher level, that is going to change your cost of capital, which is obviously negative for earnings as well. That's obvious in terms of what would affect like the debt and equity markets, or even in some cases real estate. What my theory is that if you actually pull back this whole risk off narrative of everything's going lower, sell everything, nothing's ever going higher again, and actually look at most digital assets, you can make an argument that from a pure valuation standpoint, again, not a market price standpoint of the tokens, but from a valuation standpoint, most of the blockchain companies that have a token are actually immune to rising rates. And my thesis is that most of these companies and projects don't have cash flows at all, and therefore they don't get affected by higher interest rates in a DCF model. Also, most of these companies and projects don't even have cost of goods, right? They have employee salaries in a lot of cases, but they don't have rent. They don't have any physical goods that they're buying. They're not actually affected in any way from higher prices in terms of the cost of their business. And most of them are already well financed through the issuance of tokens with a low cost of capital, because tokens are non-dilutive capital. They aren't affected by higher yields. They don't have to refinance debt. There's no ticking clock where a company is going to go bankrupt, right? Take Luna, for example, right? As bad as Luna was for everyone from an investment standpoint, the Luna blockchain never stopped working, right? They refinanced the token in 2 weeks without going through bankruptcy. There is a world where you can't kill most blockchain-based projects. They're just going to go on indefinitely forever. There's no refinancing. There's no bankruptcy. There's no, cash flow destruction. So in that way, a lot of these companies and projects, from a pure valuation standpoint, don't actually get affected in any way by rising rates. And if that's true, and we're trading down because of rising rates and inflation, but the valuation itself is unchanged, a lot of these become screaming buys. Where do you disagree with me on that?
Yeah. So I agree with points 2 and 3 that you just said there. I think those make sense. Where I disagree is the idea that an asset without cash flows would be unaffected by interest rates rising or falling. So when you think about the allocation of cash flows across a time spread, right? The ones that have the least duration are the ones that get affected the least by a change in interest rates. So if you have a bond that pays out every year, it's going to be affected less than a bond that is a zero coupon bond that pays out only at the end. And that's going to be affected less than an asset like gold, for example, that has no cash flows. Gold is essentially an infinite duration asset. And Bitcoin would be a very close proxy for that, where I think in its final state of maturity, Bitcoin is essentially an asset that trades nearly 1-for-1 with global real interest rates. Okay, that's the only thing that determines it kind of valuation.
Well, let's take something like Bitcoin or Ethereum, though, for example, and let's say that, okay, right now they generate fees, right? They're generating fees for every block, and that's largely through inflation right now of the asset itself, and not necessarily through transaction fees. As you get 10, 20, 30 years from now, most of that new inflation part of the block fees goes away, and it's 100% just transactions. So there's a world where transaction fees are going to be 100% of the cash flows, and that those transactions might be way less than what we're seeing in the inflationary rewards right now. Doesn't that make Bitcoin and Ethereum a short duration asset because more of the cash flows are being received up front than they are in the future?
I'm not following your logic there. If we're talking about, far in the future, they're going to be these big
I'm saying
assets.
there's less cash flows in the future than there are today. If you think of cash flows as the fees, because there's so much of the fees right now coming from inflationary rewards, whereas in the future it's only going to be transactions.
Yeah, I mean, if you make the assumption that they're not going to grow as kind of like economies, or that the platforms and applications on top of them aren't going to grow, then yes, I would agree with you. But I think, as digital asset investors, we're kind of making the assumption that we think these things, the fees and the kind of economic activity on these things are going to grow. And for something like Ethereum, you're going to have bigger and bigger burns of the underlying ETH token because of that activity. And those are cash flows that, farther off into the future are going to be realized.
Okay, so you're still looking at the entire digital asset space, basically just like you would look at a early stage tech company, which is if they succeed, it's a very long tail asset. All the cash flows come at the end, and therefore they're definitely affected by higher rates.
I think from the perspective of like the global macroeconomy, that's the proper way to look at them. But then from the perspective of their own internal economies, like Ethereum is its own separate economy, just like the United States economy is one. But that's like the internal perspective, versus when we look at it in the perspective of how does this affected by global interest rates and stuff, it much more acts like a early stage tech company.
Got it. Okay. Well, agree on 2 and 3 then. No cost of goods, no real pressure in terms of cost of capital or cost of goods. Debatable on the cash flows and the valuation, but we'll see how it all plays out. Again, Nick, thank you for joining me as always. And everyone else, you can read the actual blog on ar.ca/blog. Appreciate the time. Appreciate any feedback, and we'll see you next week. Thanks, Nick.
Appreciate it, Jeff. See you, everybody.